It finally happened. We actually had a 1% down day in the S&P 500. So now I can stop talking about it so much. After 23 days, we finally got a measly 1.6% drop in the market. So we'll talk about what caused that sell-off here today. We'll talk about some of the market breadth numbers. We'll talk about some of the safe havens that we discovered in today's session. We'll also take a look at our sector selector, which will identify that as of Friday night, it was giving us a little bit of a heads up sector rotation wise that we could have a day like today on the horizon. We'll also take a look at some of our macro conditions, including what's going on with treasury bonds, what's going on with Bitcoin in tonight's market outlook video as well. And then last but not least, we're going to get into our trade application example. And as often the case when we have a big sell-off day in the market, I like to sell puts on high quality dividend growth stocks. And so today we'll be concentrating on a dividend achiever that is now at a reasonable yield, where I'm going to try to get a 4% yield through an adjusted cost basis on a sold put opportunity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 25th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. At the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals. And with today being a pretty aggressive sell-off day, I imagine we'll have a few more oversold clusters in the S&P 500. In addition to that, we're heavy users of Twitter, and if you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these market outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and get started with tonight's analysis. And as always, we'll get started here on the heat map for the S&P 500. And you can see it was a little bit of a bloodbath. Now, obviously, it's been a while. I should actually maybe start the conversation with this chart that I like to bring to your attention whenever we have a 1% move either direction. And you guys have known that this has been on my mind for a while, not just because I've been talking to you about it regularly in these videos, but if you follow me on Twitter, I've also been talking about it there. And we finally, after 23 trading days, have a 1% pullback. I was glad that it happened on a Tuesday or a Thursday when I was with you here on these videos, because many of you know I like to sell puts on days like today when volatility goes up and we get juicier credits, all else being equal. So we'll talk about that later on in the video with our trade application example. But this does conclude the longest streak that we've had in the past year without a 1% drop. It was 23 trading days in a row. We'd have to go back to this day right here on March 22nd. So literally over a month ago from a calendar perspective was the last time we saw a 1% drop. And remember, this is not like some sort of a monumental event. 1% drops are very normal. They happen fairly regularly. I would venture to guess they probably happen on average at least once every 2 weeks throughout time, probably even less than that. But this happened to be a very strange period here where the markets were just grinding their way higher, climbing that wall of worry. And then today we had a little bit of a catalyst. And for those of you that weren't aware of what the catalyst may have been, from my perspective, it was what was going on with First Republic. That was one of those regional banks. If I pull up FRC here real quick, you can see what I'm referring to, because this stock got whacked today. It was down basically by half, 49.38% to be precise. So nearly half of its value evaporated in the course of one day. And of course, that is saying nothing to where it came from before today. In other words, you can see here, this stock was trading at $171 just last August, and today is an $8 stock. And, once upon a time, this was a pretty important bank, just like Silicon Valley Bank was, and to maybe a smaller degree, Signature Bank as well. So we're not talking about afterthought types of companies here. We're talking about important financial institutions. And here we go again, right? This is the one that was kind of caught up in that hoopla initially when Silicon Valley Bank went down here during the March time period, and then kind of just went sideways for most of April while the rest of the market recovered back to the upside. And this just kind of always had that nagging feeling that they weren't done with them yet, because if they were, they probably would have sent the stock price higher. So there was just these lingering concerns that we would continue to have problems with First Republic Bank of San Francisco. And today was kind of the breaking of the dam. And, there's a chance that we will be having discussions about this bank going bankrupt here, or at least going into some sort of government conservatorship or something along those lines, or maybe chopped up and sold off into pieces to other banks. There's still remaining concerns about this particular company. And so I think this was the excuse that the market used today to kind of inject a little bit more fear into the system once again. You'll notice here that the VIX was up today. It was actually up quite a bit more at the worst part of the session. It did get above 19 and almost got to 20 at the worst part of the day. The high of the VIX on the day was 19.86. We did close at 18.76. So we closed about a point off of its highs of the day. Nonetheless, a fairly decent move out of the VIX there. We don't usually like to look at the VIX on a percentage term because it itself is a percentage, but just to compare apples to apples, so to speak, it was up 11% today. So that's a pretty decent day. Then again, if you put things into context, remind yourself that 2 weeks ago, the VIX was higher than where it is right now. So it's got a lot of work to do to get back to some of those more uncomfortable moments that the market was feeling back here during the Silicon Valley Bank crisis. At that time, the VIX did manage to get above 30. But remember, during true crisis moments, the VIX generally doesn't have a problem even getting above 40 or 45. Heck, we saw it up at 80 and 90 in some of the most extreme circumstances throughout history. So where we're at right now at 18 after just a single 1% down day is still a little bit of a whimper. There's a lot more that needs to be pushed into the system before we get a little bit more fearful of things. But maybe, just maybe, what we saw with First Republic Bank is going to be a little bit of a catalyst there. Let's get back over here to the heat map. Go through some of these numbers here. You can see there wasn't a whole lot of green on the board. We had some green in the healthcare area, so stocks like Amgen and AbbVie and Johnson & Johnson, which those of you that follow my Twitter feed probably saw me tweeting about Kenvue yesterday, and some of the terms that are announced as Johnson & Johnson gets a little bit closer to the spinoff of their consumer health division. So it was up another % today. We did see Eli Lilly up today, United Healthcare, Merck. So some of the big time pharma companies managed to hold their own. We also had some really nice performance out of the consumer staples and the utilities. I'm sure we'll have this conversation a little bit more when we get to the the sector evaluation portion of tonight's presentation, but be aware that those two areas have really perked up, and that's before today. And so they were already kind of starting to assert themselves, and then to show this type of dominance where they were up nicely on a day like today is rather interesting. Just to put that into perspective, let's zoom in on the consumer staples here, and you can see most of the consumer staples closed in the green today. Some of you saw my tweet here just a moment ago where I was talking about some of those dividend aristocrats that were hitting 52-week highs here today, and some of those names included stocks like Kimberly-Clark, which is, of course, a consumer staple that sells toilet paper and tissues and different things like that. And then we also had Clorox hit a 52-week high. They did manage to close just a hair lower when it was all said and done by 0.19%. But during the course of the normal trading session, they did hit a new 52-week high. And then where's Pepsi? For some reason, I seem to be overlooking it. You know what? I think this is an issue, once again, like we were dealing with last time when we were looking at the energy sector. Thinkorswim still has not updated their sectors and industries appropriately after that big upheaval that took place last month. So we're dealing with the after effects with that, so bear with me. Obviously, I'm just the messenger here. I don't work for Thinkorswim, but if any of you have ties to Thinkorswim, maybe urge them to get it together when it comes to the sectors and the industries. That would be helpful for all of us that use their program here. But Pepsi was not listed there. But take my word for it, Pepsi not only hit a 52-week high today, it hit an all-time high. That stock is looking like a rocket. To put that into perspective, we can go back to the chart here and just give you a sense of that. And you can see it broke through those prior resistance levels back in the winter of last year. And this is a new high here for Pepsi in the beverages space within consumer staples. But for some reason, they have removed that from the heat map here, which I don't really fully understand because I don't have access to their process that they're using. All I know is it was there a few weeks ago and it no longer is. Similar to the conversation I mentioned with you guys before, where Visa and MasterCard are just missing from this, as well as Pepsi and Coke. So some very important companies that are obviously in the S&P 500 are not showing here. So it's not giving us a complete picture, but still, at least gives us a sense of things despite some of those inconveniences there. But anyway, those areas were pretty much it. Healthcare, consumer staples, utilities. And when you think of those three sectors, you tend to think defensive characteristics. Another thing I'm noticing here is that real estate is basically non-existent on here now because of that sector upheaval. And again, that's a mistake. So I'm not saying that that's what we should be expecting when we're looking at this. This is because Thinkorswim should not be operating the way that they are, quite frankly. But who am I, right? I'm just a lowly user like you guys are. But for some reason, the entire real estate sector has been omitted here from this heat map, even though you can see that it's still listed off on the left-hand side here. So, but anyway, with consumer staples, utilities, and healthcare, we generally think of those as defensive sectors. And so on a day like today, that makes some sense, right? When the growth-oriented areas of the market are struggling, the defensive areas are a place where investors tend to kind of hide out to a degree to preserve their capital. Doesn't always work, but today is a good example of how that can work, which is why I regularly remind my dividend growth investors, including just earlier today in my DGI class, that our expectations as dividend growth investors are often that we will outperform the market when the market is struggling to a degree, but oftentimes we'll underperform the market when it's roaring to the upside. We can't keep up with the tech stocks and all that kind of stuff. But on a day like today, kind of proves the value of having a dividend growth investing portfolio, because so many of those dividend growth companies are in those defensive sectors that I just mentioned there. You'll notice that pretty much everything else is in the red today. It's kind of hard to pick and choose. MSCI, which is the parent company of Standard & Poor's, was down 13%. It's rare to see that stock down that much. It's also rare to see UPS down 9.99%. It's also rare to see Danaher down 9%. And Ameriprise down 7%, and Northern Trust down 9%. These are some big numbers here today. Even ServiceNow had a pretty ugly session there, down 6%. So there were some doozies out there, a lot of them related to earnings, as you might imagine, during this time of year. Speaking of which, maybe we could rattle through some of the bigger players from an earnings perspective in the after hours session, because today was a very important day for the earnings announcement calendar with some very high level kind of noteworthy types of companies reporting after hours. And sometimes that can give us a sense as to how we're going to open up trading the following day in the normal market session. And I have some good news on that count if you're more bullish, because of course we ended quite bearishly today. If we pull up SPY, it's hard to see here on this graph, but just take my word for it that we closed basically right near the lows of the day. But in the after hours session, you'll notice that SPY went from 406.08 at the close to up here close to 408 right now. So in other words, up about $2 per share after hours. And that's not particularly normal, but can happen, if we have the right set of circumstances, right? We're only a couple of hours after the market is closed right now. So usually the market, unless there's some big economic report or something like that, which oftentimes are not issued after hours, they're usually issued in the pre-market session. But this is a kind of a peculiar afternoon where most of the high-profile companies that were reporting earnings here tonight actually are looking pretty strong in the after-hours session. So let's get into that. Microsoft, of course, is first and foremost, as they are currently the second largest publicly traded company on planet Earth. And so, they still have a lot of sway out there. Of course, that's a very buzzy name these days with their investment into ChatGPT as well. But you can see here, Microsoft was down with the normal market here in the regular session today. It was down about 2.25%, and it closed at around $275. Now, if you look at the bid and the ask here, notice that Microsoft is trading currently at $298. In fact, you can see at one point immediately after releasing their earnings, they actually were able to eclipse $300. So that's a pretty nice move. It's like a 5% move or something like that. But when we're talking about a, trillion-dollar plus type of a company like Microsoft, that can have a pretty good-sized impact on a market cap weighted index like the S&P 500. So that very much bodes well for the S&P 500 tomorrow, and the Dow and the Nasdaq for that matter. The Russell 2000 doesn't get that advantage, but the other three main indices do have pieces of Microsoft in it. So all else being equal, that's a good thing that the market is treating them so kindly here in the after-hours session tonight. Nearly as big, but not quite as big, is Alphabet/Google. They also reported after hours tonight. And of course, there's some similar themes there, as Alphabet has its own AI chatbots like Bard and others that they hope to develop over time to compete with ChatGPT. But Alphabet here, you can see, is also trading up after hours. However, they're well off of their highs. You'll notice they closed the normal session at 103.85. They're currently trading a hair above 105, so they're up a couple bucks perhaps. But you'll notice that immediately after announcing their earnings, they actually touched 110 at one point and have basically shaved off 5 of those dollars as the after-hours session has rolled along. And analysts have gotten a chance to listen to Alphabet's earnings conference call and different things like that to get a better feel of things. So a little bit of a boost there out of Alphabet. However, maybe a little bit of a letdown compared to where they were at the highs of the session here. Visa is also a big player. Like I mentioned before, it's not showing up on the heat map anymore because technically Visa is now a financials stock. Remember, we had that conversation a week or two when that big upheaval took place. But for those of you that didn't catch it, be aware that since Visa's IPO, it has been known as an information technology company, which has been a little bit odd, admittedly. But because they're not actually backing the loans of their credit cards, they're simply a kind of an intermediary. They're processing the payments themselves. They were treated differently than something like an American Express or Discover card, as was MasterCard. So MasterCard and Visa were technically known as technology companies, but they have now both been moved from technology officially into the financial space, where they will now join those other credit card companies. Also, PayPal is moving over there. So right now we're kind of in a limbo period of time here with the Thinkorswim platform, and I haven't heard any ETA as far as when they might update that, but hopefully sooner rather than later. Anyway, one of the largest newly minted financial companies now, Visa, is also trading a bit higher after hours. They closed the normal session at 229.59. and they're currently trading right around $233. So again, not a huge boost, but hey, it's anything to kind of stop the bleeding after the market kind of closed near the lows of the session today is useful and helpful to the bulls. So another little bit of a perk higher there, similar to Alphabet. Another one, this one's going to be a little bit more emphatic. However, the market cap isn't nearly as big. Nonetheless, it's an important company and one that people have loved to hate on over time. I know this firsthand because as an investment instructor with the prior company over at InvestTools or TD Ameritrade, we used to talk to people on the phone, and I talked to countless people who constantly just disregarded Chipotle because it was a quote-unquote greasy burrito company. And, as somebody who actually enjoys their burritos, I was a little taken back by that and said, have you guys ever been in line at a Chipotle? They're a money printing machine over there. Now, naturally, they did have some stumbling blocks when they had some of that E. coli outbreak and some of that type of stuff. So there was definitely a period of time where they fell out of favor, but my oh my, have they come roaring back in a big way. And look at this monstrous move they are making after hours. This is a $1,700 stock right now. Some people are surprised by that because they've never done a stock split. So they closed today's session at $1,780. And currently, after hours, they're trading at $1,919. So that's a pretty sizable move. It's probably like a 7% move or something like that. So a really nice burst higher there for Chipotle, as they, like a lot of other kind of fast food types of restaurants, have really raised prices. I'm sure most of you have noticed that, and those prices are sticking. Consumers aren't really balking at it. They are still going to their favorite restaurants and they are still ordering. So Chipotle is in a good spot for that type of behavior here at the moment, and their stock is really benefiting after hours. It looks very, very likely that we will be hitting all-time highs on Chipotle tomorrow. Let's see what else is reporting here tonight. Usually I wouldn't bring up this company because it's not particularly important, but because of the specific time that we're in right now, it might be useful to at least bring up PacWest Bancorp. They did report their earnings here today as well, and given what we saw out of First Republic here earlier today after they reported yesterday, maybe the regional bank investors can breathe a little bit of a sigh of relief, as PacWest Bancorp, after being down 9% during the normal session, is now getting most, if not all, of that back in the after hours session. They closed at $10.31. They're now trading up there close to $11.71. They did hit a high of nearly 13 in the after hours session, so down a little bit from their highs, but still maybe a little bit of a relief type of a rally in their case. Another stock that reported after hours here tonight was Enphase. Enphase has been a fairly robust growth stock over the years. They're focused on kind of the solar energy side of kind of the semiconductor business. And so, there are a number of growth focused traders that tend to focus on them a little bit more than some of the old school companies like Pepsi and McDonald's. So anyway, Enphase was reporting their earnings after the hours tonight, and you can see that they were one of the rare examples of a stock that's down, right? Most of the names we've rattled through so far have been either up very nicely or at least up a smidge. This one is an example of one that's going the opposite direction. Closed the normal session at 220. It's trading at 185 after hours right now. And then last but not least, Texas Instruments. Of course, we've got a Iron Condor going on it right now in this very paper money account from this presentation. Let's see, when did we place that trade? That was back on April 6th. So if you want to go back and listen to my analysis of the iron condor that I did on Texas Instruments, feel free to go back to the YouTube video on April 6th. But at this time, it's going reasonably well. You can see that we're basically flat on the trade as we are down a whopping $4 on it. So I'm not particularly concerned about it right now. And I would venture to guess that the after hours activity here have actually benefited us, and we'll probably see this iron condor go back into the profit zone as soon as tomorrow morning. I say that because remember, when you're doing iron condors through an earnings announcement, it can be a nerve-wracking experience because of the types of stuff we saw with Chipotle, where you have this massive rally, or perhaps like we saw with Enphase, where you completely fall on your face. Iron condors require you to have a neutral stance, and sometimes that's the enemy of the earnings announcement. But in this particular case, I think it's just what the doctor ordered, because as you can see, Texas Instruments trading at 169 as of the close. And so it was down 3.7%. You can see on our trade, by the way, because of this 3.7% down move today, we actually went from before today being profitable to now being in the loss zone because we lost $60 today. As of yesterday, we would have been up $50 or whatever it was. So what the good news is in that regard is this stock in the after hours session right now is up about $6. Guess how much it lost today? It lost about $6 in the normal session. So where we see it right now at 175 is basically just going to eliminate today's price action. So all else being equal, we should assume that that $60 we lost on this iron condor today will basically be given back to us tomorrow, and we'll see our P&L open go back to at least plus 50 tomorrow, assuming this holds, right? Sometimes things change overnight, maybe an analyst downgrade or something like that. So, but assuming we're up here trading at around 175 like we are in the after hours session right now, this is going swimmingly for our specific trade in this market outlook video here for Texas Instruments. So I like what I see out of it at the moment. All right, let's go ahead and now pop on over to the specific breadth numbers here. And you can see that with today's sell-off, only 85 stocks in the S&P 500 managed to close higher today. So that's about 17%. That's it. So one of those one-sided types of days was overwhelmingly owned by the bears, especially from a market cap perspective, where we had just a handful of defensive areas that managed to close green. Most of the the important mega cap tech types of stocks all closed under the flat line. So tough day there for the bulls. Nonetheless, some hopefully some optimism after hours tonight with some nice earnings reports that should put us on the right foot as soon as tomorrow morning. All right, let's go ahead and now take a look at our traditional 4-grid. By the way, as I pull up our charts here, here's what that Texas Instrument chart looks like. So if we get back to 175 tomorrow, we'll be nicely kind of in that middle neutral zone between our upper break-even and our lower break-even. So I like the way that this one is positioned right now. That can change. We still got 24 days to be in it, but right now I think we're in the driver's seat. Let's go ahead and get on over here now to our chart 4B. And this will allow us to see the postures of our 4 major U.S. equity indices. So first of all, let's rattle through what the damage was today. So for the S&P 500, we were down 1.58%. For the Dow Jones Industrial Average, we were down just over 1%. It was 1.02% to the downside. So it was our best performer today on a relative basis, which is oftentimes the case. Remember, the blue chips tend to go down less than other types of stocks when we have big sell-off days like this. The NASDAQ was down 1.98%, so they took it across the chin a little bit more as we had some of those more tech-oriented companies struggling a bit more today. And then the Russell 2000 was the worst performer, down 2.4%, and that goes back to what I had mentioned at the top, which was First Republic Bank basically cratered all of those regional banks once again in the normal market session, and with many of those regional banks not being part of something like the Dow or the NASDAQ. They are very much part of the Russell 2000. So right now the Russell 2000 is kind of morphed into a quasi, temperature taker of the regional bank crisis, and right now it's suffering as a result of that. So that's the bad news. We had some pretty ugly sell-offs across the board. However, you've probably noticed what the good news is, which is despite the sell-offs, we still have bullish postures across the board, which I was personally a little surprised by. Usually when you have these types of aggressive sell-offs, when the stock, or in this case the index, is crossing through the moving average the way that it is on the NASDAQ and on the Russell 2000, usually that's enough to actually drag that green line lower in order to plot a bearish posture. But we're not quite there. We're awfully close, but not quite there. In fact, because all of these still have the green background colors, we actually have bullish intermediate confirmation signals today, basically across the board. But the problem is, for those of you that have watched these videos with David and I over the last decade, you'll know that they are not what we would consider to be the idealized form of that particular signal. And the reason for that in most of the cases is that the red line is too far low, right? We sometimes it's kind of like splitting hairs, where we say, well, we want it in the lower reversal zone, but we don't want it too low, because sometimes that can tell us that there's actually a sentiment change afoot that's taking place, and that could very well be the case. But you'll notice where the red line is on the S&P 500, that momentum line, as you can read here in the label, is at 0.32. Remember, it cannot go below zero, so that is about as close to zero as you can get. The Dow is a little bit higher at 1.49, but still very, very close to the worst of conditions. And then the NASDAQ is at 0.11, even lower than the S&P 500. And not to be outdone, the Russell 2000's red line, momentum line, is at 0.07. Again, you cannot go below 0.00. So we are basically scraping the bottom on all four of these with the momentum line. And typically the way we think about that is if it is below 5.0, then we are a little bit more cautious around it. Not to say that it can't work. And for those of you that aren't familiar with these videos, if you're newer to the videos or what have you and haven't heard us talking about these before, a bullish intermediate confirmation signal is effectively like a buy the dip signal. What you're looking for is the combination of two things. The green line on the market forecast, otherwise known as the intermediate line, has to be considered bullish. Remember, it can be bullish two different ways. It can be bullish either by going up between 20 and 80. In fact, we'll use the Russell 2000 right now as that example. Notice down below, the Russell 2000's green line is traveling higher between 20 and 80. If I right click on this and maximize it, you guys can see that a little bit better, right? It's traveling higher. It's not in the upper reversal zone, but it is traveling higher, so we would still consider that to be bullish. Not as bullish as these other charts where the green line is in the upper reversal zone, nonetheless still heading in that direction. And you can see with these other three charts, the green line remains in the upper reversal zone. Now you'll notice those are actually falling. So strangely enough, the only one that's not in the upper reversal zone is rising, which is required for it to be considered bullish. And the other three are in the upper reversal zone, but they are all falling. Notice in the labels, it says falling across the board in those green labels with those three charts. So what it results in is that all four of the charts are still considered bullish, but for different reasons. And so that is step one, identifying if the green line is considered to have a bullish posture at the moment. Now, the second part of the bullish intermediate confirmation signal is discovering whether the red line is in the lower reversal zone. Unlike the way that we would evaluate the green line, that is a requirement, right? A requirement is not that the green line has to be in the upper reversal zone, as I just showed you there with the Russell 2000, but a requirement is that the red line has to be in the lower reversal zone. It can't be just traveling lower between 80 and 20. And so in that case, you can see those red lines are obviously in the lower reversal zone on all four of those charts. But what I was mentioning before is sometimes you can have extreme signals, and that's not exactly giving you the warm and fuzzies that this is a dip that you want to buy, because it's kind of telling you that there could be a sentiment change that is afoot that you have to be a little bit more wary of. And when the red lines are below 5.0 is usually during those instances, and that's what we have across the board right now. In addition to that, we also have talked about in the past how we use the blue line. Technically, the blue line is not officially part of the signal, but we use it to try to determine which signals are better and which ones are worse. And where we like to see the blue line on the days of the bullish intermediate confirmation signal is between 50 and 20. So an example of that would be the S&P 500 is actually what we want to see right now. And that kind of makes sense. You look at that S&P 500 chart, and this is a reasonable buy the dip signal, right? It's different than something like the Russell 2000, which to me looks a little uglier. And even the NASDAQ all of a sudden looks a little uglier. But with the S&P 500 still above its rising moving average, it wouldn't be the strangest thing that you've ever heard if you eventually found out that it started bouncing up and off of that moving average. So if this signal kind of encouraged you or helped give you the confidence to buy when we had a selling day like today, then so be it. So it is too bad that the red line is kind of breaching that extreme level below 5, because we actually like it where the blue line is right now. It's not too aggressive of a sell-off. And it's not too small of a sell-off. It's kind of like the Goldilocks philosophy, where the porridge isn't too cold and it's not too hot, it's just right. And that's kind of what that blue line is telling us between 50 and 20. With the Dow Jones, it's also the same thing. Notice its blue line is at 47, maybe not as good of a pullback as we saw there on the S&P 500, which pushed the blue line down to 33. Nonetheless, it at least kind of qualifies, but it still is struggling from the same thing with the red line in the extreme zone below 5. With the two charts down below, we also have the bullish intermediate confirmation signals, but you'll notice here on the NASDAQ, its near-term line is below 20. Remember, I just said a moment ago, we like to see it between 50 and 20. This one is not between 50 and 20. This one is below 20. So this is an example where, again, similar to the concept of the red line going down too far, the blue line is going down a little bit too far here as well, which is a little bit more concerning that, this could actually be a trend reversal as opposed to a dip that should be bought, right? So that's how you kind of would sort that out in your mind. And, again, that makes sense. The NASDAQ is breaching its 30-day moving average right now. So if you're thinking that one of these charts is looking uglier than the other two at the top, that's, another way to kind of look at that. The blue line is out of position because it's sold off too much, which is another way of identifying that its price activity is more aggressively selling off, in this case below the moving average, whereas the blue lines up here are in a more ideal place, and it kind of confirms what we're seeing up above, where we haven't seen breaches of the moving averages yet. And then the blue line is in a reasonable place on the Russell 2000 as well, but I just don't like the trend as much, right? This looks like it's an index that's rolling over at a lower high here. And so I think this one you still have to be a little bit more cautious around, especially when we're dealing with all of this banking news here more recently. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations, and 108 of you stepped up to the plate and clicked like for me the last time around. Anytime we're up and over 100 likes, I'm more than happy to do a full-length video, including a trade application example, which is why we are doing the video the way that we are right now. Had we been below 100 likes, then this video would already been over, and you wouldn't hear what sort of a trade application example I thought would be interesting on a day like today. So do your best to help support this presentation. We don't ask a lot out of you. It doesn't cost you a single penny. All it does is take 5 seconds out of your time, but it does go a long ways for David and I as small business owners. So thank you for those of you that help us along with that. We really appreciate your support. So let's do some shout outs here. Thank you to Rick, thank you to Surendhar, thank you to Thomas, thank you to Ken, and to Dave, and to Dave, and to Greg, and to Austin, and Anne, and Terry, and By CAE, and John, and Joel and Das and Dave and Steven and Pam and Dennis and NZ and Nina and Carl and Ron and Ash. There's my friend Yair, and there's BZ, there's Eugene and Victoria. Can't get to all of you, but I like to at least allow you to see your name in the spotlight every so often, just to acknowledge that I appreciate you and do see your likes coming in. So it's important to me as well. Thank you very much for helping support us. Let's go ahead and now talk about our sector selector. So the sector selector, a reminder, gets updated on Friday nights. If you ever forget that, you can always look at the date off to the right-hand side here. You can see here it says April 21st. Now, I bring that up every so often, but it was important for me to bring it up tonight because of what happened week over week and also what happened today. It was very interesting to see this develop the way that it did. Now remember, we use this sector selector along with the stock selector tool in my Monday morning top-down trend trading class for all of my premium members here at Market Scholars. So that's why I do it over the weekend, so we can have this, hot and ready, so to speak, on Monday morning when we're placing our trades. Here we are on Tuesday night now when I'm doing this free video on YouTube, so it is a couple of days stale. But I found it to be fascinating the way that things shook out because we had a massive upheaval in the rankings this week. And again, this was not because of what happened in the market today. What you're looking at right now was updated on Friday. And of course, I sent out the Telegram notice to all of you who are premium members as well, if you prefer to view it that way. But why I'm bringing that up is because we had a conversation yesterday morning in class before we knew what was going to happen today on Tuesday, where the markets were down 1.6% or whatever it was. But yesterday morning, when the markets were doing just fine, we had the very conversation of caution about the markets moving forward for the reason I'm about to mention. Notice here in our top 4 sectors in this week's ranking, or I should say end of last week's ranking, and look at the difference of those sectors compared to the 4 leaders that we had seen, in recent weeks and months. They are definitely different. We have healthcare as number 1 for the first time in 3 months, right? The whole point of having these kind of heavier weightings on the colors is so you guys can track your eyes backwards to see those rankings. So like healthcare is this red color, and if you follow my mouse, you can see that throughout the last 3 months, we have not been at number 1 except for this week. In fact, 3 months ago, we were 3rd from last. So this has been a slow but steady progression over the last 3 months where healthcare has continually started to pick up steam. And of course, we were taking advantage of that in my top-down trend trading class as far back as February 24th, when it got into the top 4 for the first time during that initial push there. And we were buying stocks like, Eli Lilly, I know, is one that we've had for longer, but like Novo Nordisk would be a good example of a company that we pushed into fairly early compared to most other people that have joined after the fact. And we've had some good success with that particular company. But anyway, healthcare is the new number 1. It's been many, many months since you could make that claim. Notice who is number 2. It is utilities. And same conversation. This is the highest the utilities have been in the entire 3 months that we are looking at here. Previously, the high that yellow color got to was a couple of weeks ago, and it was the number 3 position. So both healthcare and utilities are literally at their highest rankings as of Friday night that they have had in at least 3 months. It could be longer than that. Of course, we can't see this back here. I could go back and dig through my notes if I needed to, but at least 3 months, this is their highest rankings. With consumer staples, it's a little bit different, but still part of that same conversation where consumer staples are ranked number 4. They did manage to get to number 2 one week along the way, and they were also at number 4 another week. So that's not quite as rare as what we saw with healthcare and utilities, but plays into this same theme that I mentioned to my students yesterday before today's big market sell-off, which is what sector rotation is telling us right now is that we should be a little bit more cautious than we had been in previous weeks. Now, that was not somehow predicting today's big sell-off, but it is very interesting to see how that conversation got resolved as quickly as it did. I had no idea when I was having this conversation yesterday morning that today would be our big sell-off day. But we were getting an advance notice by this tool, the Sector Selector, as of Friday night, that we should be cautious around the market, because just like we see those defensive areas of healthcare, utilities, consumer staples, and REITs, all four of those going higher. Notice that REITs went from 10 to 7, staples went from 7 to 4, utilities went from 9 to 2, and healthcare went from 2 to 1. All four of those defensive areas improved in the rankings last week. And then likewise, notice what happened to most of the growth and cyclical sectors. Information technology fell off the map. In fact, when I saw this the first time, when I put it together on Friday night, I thought I had made a mistake in how I was gathering the data or doing a copy paste or what have you. Sometimes stuff just jolts for you and you're not expecting it. And that was kind of my reaction when I saw it, because I wasn't really noticing that. Now, part of the story here is, remember, this is an equal weighted system. It is not going to have an extra emphasis from stocks like Apple and Microsoft. So stocks like Apple and Microsoft, Nvidia, they've been actually holding up reasonably well. But if you look underneath the surface a little bit further to some of those, smaller large cap tech stocks, or even into the mid cap space, some of them are really starting to fall off the map a little bit more. So this was giving us the advance notice of that before today's somewhat aggressive sell-off in, even the large cap companies like your Microsofts of the world. So that was a huge drop that I was not necessarily anticipating. I wouldn't have been particularly surprised if it fell to, like, let's say 2 or 3, but I was a little bit shocked, quite frankly, to see technology fall from number 1, where it had been 4 weeks in a row, all the way to number 6. Of course, that's one of the most important growth-oriented areas of the market. Another important growth area of the market is communication services. Notice it is ranked 8th and fell all the way from number 4 last week. So that was also a big tumble. Remember, that's where you're going to find your internet giants like Alphabet and Meta and Netflix and some of the media names like Disney and those types of companies. And then if you get into the more cyclical conversation, notice that materials fell from number 6 down to number 9, and notice that energy fell from number 3 down to number 10. So, you really didn't see much in the way of good news when it came to the growth-oriented areas of the market, and where any sort of transition of strength was most definitely into those defensive areas. And we recognized this on Friday night before today's big sell-off. But today's big sell-off somewhat confirmed what the data was already telling us in advance. So I found that to be quite fascinating. It doesn't always work out that way, but it's kind of fun to show you it in real time, so to speak, here, as it just happened to us here over the last week. Let's get back on over to the main part of the platform now, and let's do some 12 grid analysis. And we'll get started here with chart 5A. This will be our asset class 12 grid. And let's get started in the lower 2 corners, like I oftentimes do with this particular 12 grid. Somewhat interestingly, the 10-year Treasury yield fell today. What we had gone through a lot in 2022 is that when the Treasury yields were spiking, those were an excuse for the stock market to sell off. Well, today the stock market sold off, but it didn't use that as an excuse. In fact, it's almost feeling like there has been a change in philosophy of the market in regards to how it thinks about Treasury yields now. Now it's almost starting to act like the Treasury yields going down is not a good thing. It's actually a bad thing, because it's basically confirming that market participants in the Treasury market are concerned that we are legitimately going to head into a recession in the future. And that oftentimes leads to interest rate cuts, which previously the market cheered, but right now it may come to that realization, like you're waking up after a hangover the next day and like, what did I do last night? What a party that was, or what have you, right? Now it's almost making you wonder if the market's coming to that realization, like, hey, we had so much fun with those lower interest rates to get that, economy revving higher, but now when we look at lower interest rates, it's a reflection that not all is well in the economy, and that things are going to get so bad that it's going to require lowering of interest rates in order to kind of stabilize the economy. So it's been interesting to see kind of that transition, that shift in thought that seems to be taking place here more recently. We closed at 3.39% on the 10-year Treasury yield. So naturally on days like that, you see a spike in U.S. Treasuries themselves, the bonds, and we had a nice move out of TLT here today. It was up 1.5%. Remember, we might be getting into that mode as well. We talked a lot about that late last year, coming into early this year, how that possibility could exist where, bonds had been bombed out last year price-wise to the point where their interest rates and their yields became actually quite attractive for basically the first time in my investing career. And therefore, if we had a continued sell-off in the stock market this year, we could actually see the bond market reverse course and start acting as a safe haven asset once again, like we've seen so many times throughout history when we've had major market crisis moments. So be aware that that possibility still exists out there. I, for one, hope we don't get there, because naturally I'm going to be hurt if the stock market goes down dramatically here this year or next year. But if it does, and you're looking for a way to try to offset some of that pain in the stock market, oftentimes the safety of the U.S. government bond will be there to help protect you to a degree. You're not going to expect to fully offset the losses, but it can at least, put a Band-Aid on your wound for a while. And so some of you may be interested in exploring, some of those government bonds. Many of you already have. If, I'm judging by the types of people that are attending my classes. A lot of us have already been dabbling in the government bond market. But today was a good day for that particular area, as you can see right here. And we're back above that rising moving average on TLT. When it comes to the other bond markets, you can see that foreign bonds also had a very nice day. They were up 0.78%. However, they're still trading right there at their moving average, and they still have a bearish posture. So right now it looks like U.S. government bonds are looking a little perkier than what we're seeing here out of foreign bonds at the moment. But both of them, generally speaking, are kind of similar in their shape of their chart. It's just that there's a little more firepower right now behind the U.S. government bonds, especially on the long side of the curve. And then high yield bonds actually closed lower today. Right? These other two bond categories were up, high yield bonds were down. That's probably a bad sign, because again, high yield bonds are kind of a reflection of risk appetite. And today was one of those days where people didn't really want to have much of a risk appetite, so they were selling off the stock market and also high yield bonds. One area that seemed to stabilize despite that was Bitcoin. Bitcoin is actually at this exact moment in time trading just a hair above its rising moving average. So we did have a pretty nasty sell-off from this high on Bitcoin back here in the middle of April to where we're at right now. That was a pretty ugly 5 out of 6 day move right there. But if you're looking for where you think Bitcoin might bounce from, this is as good of a spot as any, right here at the rising moving average. So would it be completely unheard of for Bitcoin to bounce from here? I don't think it would be. Is this the market environment for it? I have my, concerns about that. If we're all of a sudden going to be in more of a risk-off mode, then I do wonder how much Bitcoin can go up on its own without the support of kind of the NASDAQ theme pushing it along. But if the NASDAQ comes firing back tomorrow because Microsoft and Alphabet and some of these other companies are going to push it higher, then this could very well start to turn into a very nice looking bounce opportunity for Bitcoin. So keep that one on your radar there as well. In the lower left-hand corner, you're going to notice that the U.S. dollar had a decent day. That can oftentimes happen as well. The U.S. dollar is sometimes perceived as a safe haven on days of turmoil in other financial markets, and so you did have that play out today as the U.S. dollar was up 0.47%. However, we're still below the falling moving average right now, so you got a long ways to go to say you're robustly bullish on this. Right now, there's some inklings of bullishness out there after having these oversold conditions here a couple of weeks back, but you still got to break through that moving average. And right now, we just don't know. We haven't even attempted it yet. It has not touched the moving average, let alone try to get through it. So maybe that happens tomorrow. We'll find out. What's interesting is that gold is actually setting up similar to Bitcoin right now. Notice that both of them have weekly bearish postures, and both of them are bouncing up and off of their rising moving averages right now. So you might be able to get a nice bounce trade out of gold there as well. That's another area that can sometimes act differently than the stock market. So if it ended up having a reasonable year this year while the stock market ended up falling on its face, that would not be entirely surprising to me. Oil was down about 2.5% today, so a tough day there, kind of trading in the middle of the 3-month range there. And then the foreign markets were struggling today alongside the U.S. market. The foreign developed stocks outperformed by a smidge. They were still down 1.4% and retained their strongly bullish posture. And then the emerging markets underperformed the U.S. markets. They were down 1.88% and have cut cleanly through that moving average. So things all of a sudden are looking a little dicier with the emerging economies out there. However, Europe still looks reasonable here from a foreign perspective. Looking now at our sectors, it was a tough day here today for pretty much all of these sectors. However, staples and utilities held in there reasonably well. Utilities were only down 0.1%. Staples were only down 0.13%, and that makes sense based upon what we saw on the heat map at the beginning of our conversation today, and also what we recognize on the sector selector, where both the staples and the utilities were perking up week over week in their rankings. Most of the other sectors were down substantially. In terms of who the worst sector was, let's see, was it materials? Yeah, I think it was materials. They were down 2.17% today, just barely eclipsing the 2.13% drop in technology sector. Let's get into our trade application example now. And as I hinted to earlier in the presentation, many of you guys know my philosophy by now. But if you're newer to the video, because we always get new people showing up here and there as well, be aware that on days when the S&P 500 is down more than 1%, I like to sell puts on those days. I like to get the extra premium out of a boosted up VIX that comes with a day when the market is down over 1%. But it is not for the faint of heart. You have to be somewhat brave in doing that because you're doing something that's different than the rest of the market when you are selling a put, because it is a bullish trade. So I always like to provide that proper disclosure up front, because I will tell you it's not for everybody. I enjoy it, and many of my students do as well, but it doesn't mean that all of you watching this free video on YouTube have to also enjoy it. So to each their own there. But what I tend to do is look for stocks that have longer histories of growing dividends to sell puts on, which basically means that I'm going to try to identify a strike price where I might be comfortable buying a stock that is lower than where it is currently trading. As mentioned on the heat map, one of the worst performing stocks in the S&P 500 today was UPS after they announced their earnings. Now you can see over the last 10 years of this dividend stair-step chart, UPS has done just fine. So we had a little conversation about that in my DGI class today, and a lot of it just comes down to personal perspective and where you may have gotten involved with it in the past. But obviously there's been plenty of times when it was out of favor over here in the blue zone as well, and that led to this massive surge eventually playing catch up to the upside. Now we've been kind of meandering sideways for a while, and before today it was trading in the white zone above this blue dividend stair-step line, but after today's sell-off, it is now back into that blue zone right there. And so some of you might decide, hey, this is a buyable candidate right now if you were looking for exposure to the transportation or industrials area in your portfolio, as UPS does have a longer history of growing dividends. I think I've got a spreadsheet here that will show they have 14 years in a row of dividend increases. So it does not make them a dividend aristocrat. It's not one of those, top shelf companies like McDonald's or Pepsi, but of the non-aristocrats that are out there, I think it's kind of in that first tier of non-aristocrats, at least in my head. It's a very well-regarded blue chip company with a wide economic moat, and it has a reasonable yield well above 3%, and it has reasonable dividend growth rates, oftentimes between 6 and 12% over the years, which is pretty good for this type of old school cash flowing type of a business. Its dividend payout ratio, or I should say its earnings per share payout ratio, is only 49%. So only 49% of their earnings is currently being paid out as a dividend, which means all else being equal, we should assume that they will probably continue to grow the dividends. Now remember, UPS is very cyclical in the industrial sector, so we have to be mindful of that. It is entirely possible that if we go into a recession in the future, UPS's earnings per share could go down fairly dramatically next year, which by itself would increase that payout ratio. So remember, this is kind of a moving target here, but for right now, it does look reasonably safe. The PE ratio, even before today, because this spreadsheet is a few weeks old by now, is still cheap at 14 times earnings. That's cheaper than the market at large. It has an outstanding ROE, so it's a very profitable business, almost operating as an oligopoly in a package delivery across the globe, alongside, of course, FedEx and DHL and some of the big Asian players. But for the most part, they're the only game in town in some instances, so they can charge higher amounts for their services. They have a reasonable debt load as well. I oftentimes like to see this debt to equity number under 1.0, and it just barely makes that. And then the beta is a little bit more than 1.0, so it's got a little bit more volatility than the typical stock, but that's not particularly uncommon for a more cyclical sector like the industrial. So those are some pretty good metrics. Also, not that it has to be that important, but there's a company out there called Simply Safe Dividends that tries to evaluate the safety of the dividends of various companies out there. And I did notice that they score UPS as a 69. Now that's on a 1 through 99 scale, with 99 being the best, and anything effectively above 60 they consider to be safe. So it's reasonable from that perspective as well. It might not be a slam dunk, but at least it's in that territory where you feel a little bit more comfortable with the merchandise, because again, each one of you has to make the decision for yourself whether UPS is a company that you want to have in your long-term portfolio or not. But I at least thought it was reasonable for a trade application example tonight. Typically, I don't buy long-term positions in this particular account, because this is meant to be a trading account where we're doing multiple trades per week, and we can't chew up all of our buying power by having long-term buy and hold positions the way that we can in, let's say, my DGI class, where that's exactly what I teach. So oftentimes in this class, as kind of a proxy to that mindset of recognizing a blue chip company at a valuable level, I will sell a put instead. And typically what I try to focus on is the 1% return on risk when you're looking at about a 30 to 60 day window, somewhere in that general vicinity. So that brings me at this point to the June contracts, the June monthly contracts for UPS. And I sold the 160 puts, which is approximately right here on this chart, and I sold those puts for $1.61. And so my break even on that trade would be 160, which is the strike price, minus the credit that I took in of $1.61. Then my break even on that theoretically would be $158.39. So in other words, if this stock falls from 176 down to below 160 on expiration day in June, then I'm going to be on the hook for buying 100 shares of this stock. Now, of course, you can get out of the trade by rolling it or shutting it down along the way, but just I like to think in those terms ahead of time to make sure I'm comfortable with the worst case scenario, right? Because that's where a lot of people get themselves into trouble with selling puts on companies they have zero interest in actually owning. So that's why I try to train my students to only sell puts on stocks they actually want to be the business owners of for the foreseeable future, because then they can get into the win-win mindset. One of two things can happen on a company that you're selling puts on that you actually want to own at a lower price. Either the stock in this case, goes somewhere other than below 160. So in other words, the stock could go sideways here at 176. It could go back up to 197. It could even go down to, let's say, 165, but not below 160. And in all of those cases, we get to keep the $161 that we just took in as credit for this trade. So that's one possible outcome. The only other possible outcome is that that doesn't happen. And the only other thing that that can infer is that it goes below 160. And so if you have the mindset that you actually want to buy this company at 160 or below, you should not look at that as though it is a negative outcome. So that's where that win-win mindset comes from. Now, at this level of 160, when you take out the 161 of credit that we received, our break even or our cost basis on that, if let's say this stock falls down to 155 or something like that, and we're forced to take ownership of it and we don't trade out of our position, then our cost basis would be $158.39. So a lot of times I like to work out what our dividend yield would be at that expected cost basis. And right now, this company is paying $1.62 per quarter. They just increased their dividend here more recently. Take that times 4 to annualize that quarterly dividend, and we are expecting UPS to pay out about $6.48 per share this full year. And so we divide that then, now that we've annualized that dividend amount, by our expected cost basis of 158.39, and our dividend yield would be, hang on, I must not have done that right. So sometimes my mouse slips, so let me try it again. 162 times 4 to annualize it, there we go, and divide that by 158.39. Again, that's our break even, our adjusted break even on this trade theoretically. And that means that our dividend yield would be 4.09%. Right now, its current dividend yield, if you were to buy it outright, is 3.68%. So that's the benefit of trying to get filled on a long-term position through the use of a sold put, is that theoretically you could improve your yield on cost if it plays out the way that you think it will. But of course, there are disadvantages of that as well, and we don't have the time in this type of video to get into any of the disadvantages. But for those of you that are premium members of Market Scholars, just watch my Monday afternoon classes. In all of them, we go through the pros and cons slide at the beginning of class where you can work that through yourself. But this at least gives you a basic idea as to what it is that I'm hoping to accomplish here, right? I'm recognizing a company that I admire, that has a long history, at least 14 years in this case, of dividend growth, that has already an attractive 3.68% yield, but I'm trying to get an even better starting yield of over 4%, and I can do that through the options market by selling a put like I've showed you here in this example tonight. Okay, so that's what I had for you here tonight. If you appreciated the walkthrough of that trade application example and the philosophy that goes into it, or if you appreciated the run through of the various earnings reports or anything else that I shared with you in tonight's video, I have one simple request to ask out of you, and that's simply click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do this video again on Thursday, I'll plan on doing another full-length video like this with another trade application example. On the other hand, if you think these videos are a little bit too long for your liking and you'd prefer only a 15-minute video, then don't click like. And if we're under 100 likes, then I'll just keep it short and simple that day with no trade application examples. So that way you guys can have kind of a little bit of a fingerprint on how we move forward here with my presentation. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.